Welcome to the deep dive.
Everywhere you look, all the talk is about AI, how fast it's moving, the new models, the chips, the sheer power of it all.
It's genuinely breathtaking technology.
Absolutely. But today, we're actually going to shift focus. We want to look past the tech itself, beyond the code and the silicon.
And look straight at the money, where it's moving and how fast it's moving. It's kind of terrifying, really.
See, exactly. When you have a revolution this big, the financial reaction, well, it often hits harder and faster than the tech adoption itself, doesn't it?
Oh, definitely. Think of the AI boom like this enormous wave. But we're not just looking at the crest, the exciting part.
All right.
We're trying to analyze the displacement, the undertow, what Tenenbaum calls the invisible tsunami of capital. It's all being funneled into AI.
Leaving the rest of the economy kind of high and dry.
Starved,
Yeah.
destabilized. That's the core idea we're exploring. So our mission today is to cut through that tech hype and really dig into the economic shift that's happening underneath. We're drawing a lot from a really insightful discussion led by Muki Tenenbaum and Claudio Sucevicchi. They offer this deep financial perspective.
Yeah, their focus is really on where the big money is going because, let's face it, financial markets, they price in the future.
Not what's happening today.
Exactly. So if you want to see the roadmap for the next, say, 10 years, you look at what the absolute biggest players are doing now.
We're talking BlackRock, Blackstone, JP Morgan, Morgan Stanley.
The giants, they own stakes in, well, countless companies globally. And right now, their actions are showing us exactly where economic value is flowing or maybe draining to.
Okay, let's unpack that.
Yeah.
Starting with just the sheer scale of this investment shift. This isn't just individuals buying stock anymore.
No, we're talking institutions moving like tectonic plates of wealth.
So what does that look like on the ground, this institutional rush?
Well, the defining thing is the speed.
Yeah.
And the totality of the commitment. These massive global funds, pension funds, sovereign wealth funds, the huge private equity firms.
They're not just dipping a toe in.
Not at all. They're channeling just unprecedented amounts of capital, mostly towards the AI infrastructure leaders.
So chip makers, platform providers.
Right. Through direct ownership, funding rounds for building out capacity, big equity positions. It's a massive inflow.
And the market mechanics just amplify this, right?
Yeah.
The concentration is, it's kind of staggering.
It really is. Just look at the S&P 500 index weight. NVIDIA, one single company, now makes up something like 12% of the entire index.
Wow. One company pulling the weight for thousands of others in that index.
And that's just NVIDIA. You add in the other big tech players, the cloud providers, the platforms enabling AI.
The ones that make it all work.
You're talking about roughly a third of the entire S&P 500's value. And that third is attracting almost all the major global capital inflows.
So if you're managing a fund in London or Tokyo,
Where else are you going to put your money? You chase the growth. And right now, that growth is incredibly concentrated in these US-based AI stocks.
okay, but hang on. Is this purely rational, just cold, hard calculation? Because Tenenbaum brings up this fascinating psychological angle.
Yes. Corporate FOMO.
Fear of missing out. But for the big guys, not just, retail traders chasing memes.
Exactly. We usually think of FOMO as like amateur hour, but the corporate version, especially at the director level, it's deeply tied to career survival.
Liability almost.
You got it. Tenenbaum used that great analogy, reminding us of the old Wall Street saying,
Nobody was fired for buying IBM.
Precisely. Back then, IBM was the absolute standard, the safest bet for enterprise tech.
So if you put company money into IBM and it didn't do amazing,
You could just say, hey, I picked the industry standard, the safe choice. It was a shield, protects your job.
and today AI is that shield.
Totally. If you're a fund manager, an executive, and you pour millions, billions into NVIDIA, even if you secretly think, this valuation feels a bit high.
You're making the safe career move.
Right. If AI keeps booming, you look brilliant. Get your bonus. If it dips slightly, well, everyone else is in it too.
But the real fear is missing it entirely.
That's the killer. Imagine AI stocks double again in 18 months and you were underweight. That's professional suicide. You don't want to be that person.
The one who missed the biggest shift in a generation.
No way. So this adds this really personal, almost primal fear into decisions involving huge sums of money. It's not just about ROI anymore.
It's about not getting blamed.
It's about professional survival, which makes the capital flow almost inevitable, doesn't it? Whether it's rational projection or just fear, the money rushes in.
Into this very small, very concentrated pool.
And that momentum, that rush, it brings us straight to the core idea from Mookie Tenenbaum and his colleagues, this invisible tsunami.
Because if all that money flows into AI,
It has to be flowing out from somewhere else. And that suction, that's the destructive part we don't always see immediately.
Tenenbaum actually called AI stocks a capital vacuum cleaner, right? The aspiradora.
It's such a perfect metaphor because it's this passive, almost quiet, but incredibly powerful removal of resources.
From the rest of the economy,
Yeah,
the traditional sectors.
exactly. The non-AI companies, the sprawling industries we rely on, they're facing this catastrophic double whammy.
Okay, first threat is obvious. AI tech itself disrupts their business model, replaces products, services.
Yeah, that's the direct hit. But the second threat, that's the capital flight.
The money they need just to operate, it's leaving.
Literally being sucked out of their ecosystem. Think about it. The funding for their basic operations, R&D, payroll, expansion, it's drying up because it's all going to NVIDIA, to TSMC, to the AI darlings.
So their business is under attack, and their funding is disappearing.
It's a brutal pincer movement, an existential threat to their revenue, and a strangulation of their funding.
And are we seeing concrete signs of this capital vacuum creating problem?
Oh, absolutely. We're seeing real-world signals of a potential credit crisis brewing outside of tech.
Like what specifically?
Well, the sources we looked at point to growing doubts about corporate bonds globally. Remember, corporate bonds are basically loans that companies use for long-term financing.
Okay.
When the big institutional investors start getting nervous about those bonds, it means they think the companies issuing them, the non-AI, real economy businesses, might actually struggle to pay that money back.
And this isn't just market chatter. It's the big banks acting.
Right.
JP Morgan, Morgan Stanley.
Precisely. They're actively reducing their investment in traditional corporate debt. Some are even starving it.
Wow. That's not passive. That's an intentional withdrawal.
It's a strategic choice. They're pulling back liquidity because they anticipate these non-AI companies are going to face serious repayment risks. Why? Declining profits, tech making them obsolete. It all points to trouble.
Okay, I need to really grasp this. What happens to, say, a normal manufacturing company when JP Morgan says, we're backing away from corporate bonds like yours?
It hits them hard and fast. Two ways. First, less liquidity in the system makes their day-to-day cash flow much harder to manage.
Okay, less cash floating around.
Second, and maybe worse, their borrowing costs skyrocket. If they need a new loan or need to refinance old debt, the interest rates they have to pay go way up.
Because they're suddenly seen as much riskier.
Exactly. So they're being financially starved. Less money available, and the money they can get is way more expensive. It cuts off the oxygen they need to survive, let alone adapt.
And Tenenbaum pointed out this isn't just a U.S. problem. It becomes global. Global descapitalization, he called it.
Yes, because that capital getting vacuumed up by US AI stocks, it's not just coming from Wall Street. It's being pulled from Europe, from Asia, from emerging markets.
Like water draining from everywhere into one deep pool.
Perfect analogy. The US AI pool is getting incredibly deep, and it's lowering the water level everywhere else. And think about currency stability, too.
How did that play in?
Well, even if U.S. inflation is, say, 3%, that might look way better than 5% or more somewhere in Europe or Asia, so that encourages more capital to flee those regions and seek safety.
Which now means USAI stocks.
Right. Perceived quality, perceived safety is shifting dramatically.
So investors globally are selling local stuff bonds, local stocks converting to U.S. dollars, and buying NVIDIA or Microsoft.
That's the dynamic. And the result is the rest of the world loses the critical financial resources needed to maintain its own infrastructure, its manufacturing, its local businesses.
All because the AI magnet in the U.S. is just too powerful to resist.
It's a massive destabilizing drain.
Okay, so to really understand the threat to even established non-AI giants, we need to talk data.
Absolutely. Data is the new oil, the new gold. Whatever metaphor you want, it's essential.
For efficiency, costs, customer understanding.
Everything. And crucially, AI feeds on data. If you lose control of your data stream, you basically lose control of your market position.
Which brings us to that Walmart example Tenenbaum discussed. This sounds kind of shocking for a giant like Walmart.
It really is. The idea that Walmart would allow customers to make purchases entirely through, say, ChatGPT.
On the surface, it sounds like embracing new tech. Right. Meeting customers where they are.
Maybe, but Tenenbaum's take is quite different. He sees it as a move driven by fear, pure, raw fear.
Fear. How so?
Because by doing that, Walmart is essentially sacrificing its direct digital relationship with the customer. They're letting an external AI, likely controlled by Microsoft or Google, handle the interface.
And in doing so, they lose the data.
They lose the invaluable, incredibly rich data about consumer habits, what people browse, what they almost buy, how they react to offers.
That's the lifeblood of modern retail, isn't it? That dictates everything from inventory to personalized ads.
Everything. They lose the ability to see that whole customer journey, the click stream, the segmentation, the predictive modeling, the value of their entire online business built on harvesting that data.
It just evaporates. Or gets absorbed by the AI platform.
Pretty much. It gets absorbed by the third-party AI. Walmart basically hands over its core digital competitive advantage.
Just to stay in the game digitally.
To remain relevant in that digital conversation, exactly.
Yeah.
So what's left for Walmart as their unique strength?
Their physical stores.
Yeah.
The logistics network.
Their brick-and-mortar presence, the massive, expensive physical network, that becomes their main asset. But the overall profitability...
Takes a big hit because the high-margin digital data play is gone.
Precisely. They lose control of that critical customer relationship online.
And the fallout doesn't just stop with Walmart's profits, does it? A giant like that, facing lower margins, they're going to react.
Oh, the reaction will ripple through the entire supply chain. Immediately, brutally.
Oh.
They'll renegotiate supplier contracts, demand lower prices, tighter margins, longer payment terms. They'll squeeze every single company that sells them goods.
So this is the Aspirador, the vacuum cleaner effect playing out in the physical economy.
Yeah.
Starts with finance, but hits the supply chain hard.
Yes, the capital vacuum restricts funding, right? But then this technological vacuum, like the Walmart example, accelerates the pain on the ground.
Affecting everyone down the line. Logistics firms, food producers.
Everyone. Companies already struggling to get loans because of that credit crunch we talked about. Now their biggest customer is squeezing their margins down to nothing.
It's a vicious cycle.
Triggered entirely by AI's dominance reshaping the landscape.
Okay, so the AI boom is happening. Money's pouring in. But for the average investor, there's a common mistake, isn't there? They see NVIDIA's already surged.
And they think, okay, I missed that rocket ship. Let me find the next AI company that hasn't popped yet, the undervalued one.
Looking for a bargain in the AI space.
And Tenenbaum had a really strong warning about this. He basically said, look, most companies that haven't risen with the tide, there's usually a very good reason.
They're not hidden gems.
Probably not. More likely they're obsolete, or they lack the data advantage, or they're actually going to be hurt. Cannibalized by the big AI players.
So chasing those laggards is probably a bad strategy.
Almost always leads to losses, not finding the next big thing. The market isn't stupid, usually.
And this kind of irrational hope gets magnified even more in the startup world, right? The private investment.
Oh, massively. You see just pure euphoria there. Valuations that are, well, disconnected from reality.
Like companies with hardly any revenue.
Maybe $5 million a year, tops. And they're getting funding rounds of hundreds of millions, leading to billion-dollar valuations.
Based purely on promise, hope.
Pretty much. It's narrative over numbers, and Tenenbaum used this fantastic analogy, quoting an old saying.
Which one was that?
Ravioli in a dream are not ravioli, they are a dream.
That's brilliant. What's the meaning there for these startups?
It means they're selling smoke and mirrors. They're selling the idea of ravioli, the potential for a delicious meal someday. But right now, there's no actual ravioli on the plate.
The valuation is based on a dream of future success, not present reality.
Exactly. No real assets, no significant revenue stream to justify that billion-dollar price tag. When the hype fades, there might be nothing tangible there.
And even if these startups have some interesting tech, they face huge risks, don't they?
A dual risk, really, making them incredibly speculative. First, competitive destruction.
Meaning the giants just copy them.
Or just outmuscle them. Google, Amazon, Meta,
Right.
They can replicate a niche product and scale it instantly with way more money and data. Crushes the startup.
Okay. Risk one, annihilation. What's risk two?
Acquisition, which sounds okay, maybe it's the best exit, but the return for the early investors often ends up being disappointing compared to those crazy initial valuations.
Diluted returns.
Right. They're just inherently unstable, high-risk bets.
So this instability leads to another trap.
Yeah.
People trying to get AI exposure indirectly. They see BlackRock investing heavily or SoftBank.
And they think, okay, I'll just buy BlackRock stock or a SoftBank share, get my AI exposure that way.
Seems logical, but what's the catch?
The catch is dilution and legacy baggage. Take SoftBank. Great example. Yes, they own a big stake in ARM, which is crucial for AI.
Right.
But if you buy SoftBank stock, you're also buying their entire other portfolio, including all our past mistakes, like WeWork. Remember that disaster?
Oh, yeah. Big write-offs.
So that potential AI gain gets dragged down by all the other stuff, the baggage from the holding company.
You're mixing the good with the bad. What about just buying an AI-focused ETF, say, from BlackRock? Is that still diluted?
It's better, but yeah, still diluted to some extent. Even those dedicated ETFs often have a broad definition of AI-centric.
Not just the pure plays.
Often not. Maybe 75% pure AI, maybe less. You're still mixing that core AI growth signal with companies that are more tied to the contracting other economy, as Tenenbaum puts it.
So if you really want to bet purely on the AI boom...
You need to be surgical. You need to invest directly in those core infrastructure providers. NVIDIA, TSMC, the platforms. Indirect routes just muddy the waters.
Okay, we absolutely have to address the big question. Is this just another tech bubble, like the dot-com crash in 2000?
Yeah.
Is it all going to burst?
It's the question everyone asks, and Tenenbaum offered a really crucial point of difference. Leverage. Or apalancamiento, as they say.
Leverage.
Meaning borrowed money.
Exactly. Think about recent crashes, like in parts of the crypto market. What fueled those collapses? Massive leverage. People borrowing heavily to buy assets.
Using margin, yeah. Sometimes 70%, 80% leverage. So if the price dropped just a little bit...
It triggered margin calls, forced selling.
A complete cascade. Massive losses, 70-80% wiped out, because the whole structure was built on borrowed money.
Okay, so how does the leverage situation look in AI stocks right now? Like NVIDIA.
It's completely different. The core AI players, NVIDIA, TSMC, the big platforms, have incredibly low leverage. We're talking like 1%, maybe 2%.
So the money going in isn't borrowed?
Mostly, no. It's real institutional money. Pension funds, sovereign wealth funds. It's sticky money, not speculative debt funding the stock purchases.
So if NVIDIA's price drops 10%,
there's no systemic trigger for forced selling, no margin call cascade. The underlying financial structure is way, way more solid than in past bubbles.
that low leverage is key, which leads to that really provocative idea Tenenbaum raised. Maybe the bubble isn't in AI.
Right. Maybe the bubble is actually outside AI.
In the traditional economy.
Think about it. Those traditional companies facing obsolescence, losing their data edge, getting starved of capital, their current valuations might be the ones that are totally unrealistic.
They're the ones that look overvalued, given their future prospects.
Exactly. Maybe they are the assets ripe for a massive correction. The bubble is in the old economy, not the new one. That flips the whole script.
And that perception shift, it changes everything for investors, doesn't it? We have to ask this question, which sounds crazy. When do AI stocks like NVIDIA become safer than government bonds?
Safer than U.S. Treasuries? German bonds? It used to be unthinkable.
But look at the trajectory.
We're heading there. NVIDIA's market cap is already bigger than the entire GDP of Germany.
That's insane.
As these AI companies keep showing huge profits and maintain that super low leverage, investors will increasingly see them not just as growth stocks, but as stocks of value.
Like the ultimate safe haven.
Potentially. Like those big Israeli banks were perceived before their crisis, seen as fundamentally safer than the government because their business model felt more secure. AI dominance could create that same perception.
This massive shift really underlines Tenenbaum's final point, the core distinction he made about this revolution.
Yes. This isn't just another tech revolution, it's different.
How so? Different from the internet boom, for example.
The internet in 2001, that was about efficiency. It changed how we did things, communication, information access. But AI, Tenenbaum argues this is a cognitive revolution.
Cognitive, meaning it changes thinking itself.
It changes the value of human thought. It fundamentally alters the human cognitive model and, crucially, the economic worth of existing human knowledge.
Because AI can now do things that required years of human training, writing legal briefs, coding software, financial analysis.
Exactly. The value of all that accumulated human expertise is suddenly questioned, potentially devalued, maybe even made worthless in the market very quickly.
Wow. Tenenbaum said we have no historical precedent for this study. No.
Yeah. Since the invention of writing itself, that was arguably the last time the actual structure of human knowledge and how we value it was so fundamentally changed.
Which means predicting the future based on past economic cycles.
Yeah.
It might be useless.
The old playbooks don't apply. The outcome is inherently radical because the change itself is radical.
And this cognitive shift directly fuels that capital drain we talked about. Why invest in a company reliant on expensive human brains?
When the AI alternative is cheaper, faster, infinitely scalable, and doesn't form unions.
Right. Capital flows to where the cognitive bottleneck is being broken.
Precisely, and that radical potential even extends into, well, money itself.
The idea that AI companies like NVIDIA might issue their own currency.
It sounds like sci-fi now, but imagine a digital currency backed not by a government promise, but by the actual physical productive power of NVIDIA's GPU infrastructure.
Guaranteed by computing power.
It could theoretically offer a kind of stability and utility that could compete with Bitcoin, maybe even with state-backed digital currencies down the line.
Cementing them not just as companies, but as almost sovereign economic entities.
Issuing their own money. It's a wild thought, but it shows the scale of the potential transformation. #tag outro.
So, wrapping this up, the big takeaway from Mookie Tenenbaum's analysis seems crystal clear. His phrase really sticks. You haven't seen anything yet.
Yeah, that sums it up. This massive capital shift we're seeing, it feels like just the beginning, the early stages, driven a lot by that corporate FOMO, that psychology.
And if these trends continue, the vacuum effect, the low leverage in AI, the cognitive devaluation hitting older businesses,
Then the current valuations for those core AI players, they might seem high now, but they could end up looking, well, almost infinitely low in hindsight.
we are genuinely witnessing an economic shift unlike anything in modern history.
It feels that way.
So we want to leave you, the listener, with a final thought, a provocative one, maybe a necessary one. If AI truly is this cognitive revolution, fundamentally changing what knowledge is worth,
You have to ask yourself, what specific skills, what knowledge you currently possess might AI devalue fastest, say, in the next 3 years?
it's time to really think about the financial vulnerability of your own personal cognitive model in this new world, something to definitely mull over.